Hi, I'm Jason Jessup, CEO of Magna Mining. Magna is a Sudbury-focused exploration development company with 2 advanced stage nickel copper PGM assets in Sudbury.
Jason, good to see you again. I haven't seen you since December. In fact, I managed to catch up with you, Mines and Money as well. Good catch up there off screen, as it were. Hey, wow. Things have changed since we last spoke. 50 cents. I think you got up to its highest 149, so down at a sort of more respectable 110 at the moment. You guys must be pleased with the reaction from the marketplace.
We definitely are quite pleased. It's been a great reaction and not overly surprising, but you never know. We put out some great drill results. We had a very well received financing private placement that we announced last week. So things are on track, moving forward quite well, and the markets are receiving it very positively.
Yeah. So let's talk about what exactly people are excited about, and it's got to go straight to grade. I mean, you talk about I think it was 4% over 31 meters. That's exceptional when it comes to nickel, anyway. And you're talking it's quite shallow at the moment. So we look back at the last 3 holes, super positive, one better than the last. You can't keep that going. So what's the plan when it comes to the drilling and the drill bit and where you're targeting?
So to reiterate, our first program we drilled back in 10 holes back in November. That was really drilling within the resource to support our PEA, which is well underway. The drilling has, given us new data, a better understanding, specifically and especially in the footwall areas of the 101 footwall and the 109 footwall. These are 2 areas that were previously misinterpreted by the previous owners. And now that we've drilled them, we have our own core, we've studied them, we recognize that these are 2 Sudbury breccia hosted footwall zones. One very dominant in nickel, one rich in precious metals and lower sulfide, but still with a very high grade, massive sulfide nickel copper PGM core. So we are taking this data, we're using this to optimize our PEA mine plan. Now that was the 10 holes we drilled back in November. We started drilling last week and I think we're halfway done our second hole now. And the drilling in 2023 is going to be exploration based. It is going to be the purpose to extend resources as well as to test new theories and exploration targets, especially in the footwall, where we believe that there's really good potential for a new discovery.
Right, but given how things have advanced relatively quickly and of the success of the drill bit recently, you've started a PEA process. It was a very difficult environment for economic studies last year. Companies putting them out invariably got punished because it showed, quite a difficult capital structure for most. I mean, given the success of the drill bit, would you be excused, or is there any intention to maybe extend this exploration component and extend the amount of drilling and the amount of capital thrown at that and delay the PEA?
No, we have a very significant resource. 31 million tons of indicated resource between open pit and underground. So we do not need more resources to start looking at mining scenarios. The great thing about our resources at Crean Hill is they start near surface and at surface in some areas, such as the 109 footwall. So the ability to take advantage of that shallow, high grade resource in a potential mining method, and especially utilizing one of the 2 underutilized mills that are operating in the area, we think is a great opportunity. And that's what's going to be explored with the PEA, as well as some trade-offs and synergies with Shakespeare. But we think that there's some real advantages, and especially when we have such high-grade mineralization on surface that could be very highly profitable, high-margin type material. So we're working through that process. We still are targeting early in Q2 to have the PEA completed. And, we think it will be able to demonstrate the potential economics very well and give us some recommendations for further work that needs to be done looking forward towards potential construction and commercial production decision.
Right. Okay. So I think everyone's got excited. You sound a bit excited and, really looking forward. You haven't even delivered a PEA yet, but do the grades at the depths that you're finding them, do they say to you, given your previous experience, I'm not asking you to make forward-looking statements, but can you give us some indicative statements about how you feel about how you can approach this? Do those grades at the depths that they're at allow you to perhaps accelerate the economic phase of this? Because you're already in this conversation talking about, well, potentially with tolling, you can get some cash flow that could, help reduce the dilution for shareholders, could help you with your expansion into production further down the line. So how are you viewing this project?
Yeah, so to give a little bit of background, Matt, for yourself and for your viewers, my background largely in Sudbury. I spent 6 years with FNX Mining, right from the time we were just really getting going at the McCreedy West mine, which is the first mine FNX brought into production, all the way through the development, commercial production at the Levack mine and the Podolsky mine. So really, I'm taking that experience that we had, and much of our team are our former FNX colleagues, taking that experience and using that when we start looking at opportunities for early stage near-term production. What we see here is much like what we saw at FNX. There's resources near surface, easily accessible. In this case, we are looking at both open pit, so potential starter pits near surface, as well as potential ramp access, which would be a new ramp development, but to shallow depths. And this is what the PEA is looking at. What's that balance between open pit and underground? Where should we start mining? Where do we potentially want to look at a bulk sample to get better understanding, especially of the 101 and the 109 footwall zones? So these are the things we're looking at. But we previously at FNX, we mined many deposits that were not in any form of PEA or pre-feasibility study, because our team has been in Sudbury for decades, has mined these deposits. I think one strength we absolutely have that's undisputable is we have a very strong geological team. We're very much focused on Sudbury because that's where our experience and expertise for decades has been. So we're using that to get an understanding, and we have well drilled off resources. We believe that based on these grades, there's a high probability that we can move them forward economically.
Right. Okay. So, again, for the uninitiated, please explain who FNX is. What did they do? Why would you determine that as a successful strategy, and why would you want to emulate them?
So, back in around 2002, FNX was a junior company, 25-cent stock, led by Terry McGibbon, who was formerly the VP of Exploration for Inco here in Sudbury. And he was leading this FNX junior team, was able to acquire 5 past-producing properties from Inco, and then continued on to explore them. In late in 2003, brought the McCreedy West mine back into production through toll milling. I joined about a year after that, and then subsequently made some discoveries in the footwall. At a time when metal prices, we were in a bull market for nickel and copper, made a discovery at the Podolsky mine, started sinking a shaft out there. And so we were able to, using cash flow from the McCreedy West mine, fund the construction and the restart of the Levack mine and the Podolsky mine. And ultimately, from 2002, raised their first money at 25 cents. We raised money at 27 cents for our acquisition, traded up by 2007 to a high of $39. And between 2000 and 2010, FNX Mining was the best performing stock on the TSX. So it was a fantastic ride. A lot of things went right, a lot of timing, but I would give a lot of credit to our exploration team and our operations team, which I was a big part of. I think we did a lot of things right, and very different than the approach that the majors would typically take here in Sudbury.
Right. So let's talk about a few of the details here, because I always love getting into the detail when there's a plan. So with regards to let's start with the drilling first. So you talk about a big exploration program. You obviously raised 20 million back in September. You raised 16 million last week, and I'm not sure when that will actually close. But how much exploration drilling will happen this year, and what could that add to you in terms of the size of the resource? Or is it more about getting more certainty around the resource that you've got, which is already quite big?
Yeah. So prior to this financing, we had budgeted 15,000 meters of exploration drilling at Crean Hill and another 3,000 to 5,000 meters in 2023 for Shakespeare and the regional targets that we have. Now with this larger financing, it does beg the question, we have the capacity to do quite a bit more drilling. So we're looking at that right now, trying to determine exactly how much more drilling we want to do. We do have until the end of 2024 to spend all of this flow through, so we can spread it out over 2 years, essentially. So we're just trying to determine. More than likely, we will start up a second drill at Crean Hill sometime in the next 3 or 4 months, because we will be wanting to test some deeper targets. These footwall environments can go very deep. There's been, some drilling in the first 300 meters from surface, but historically, the Crean Hill mine was mined down to approximately 1,400 meters. So there's a lot of mineral-rich environment in the footwall that has never been tested. It was not a focus of Inco because they were very much focused on nickel. Typically, these footwall deposits are predominantly chalcopyrite, copper mineralization with PGMs, with a nickel byproduct, which could be significant, but they're not the massive sulfide nickel type or contact deposits that Inco mines. So very underexplored footwall. So when we want to start drilling some deeper holes, it probably makes sense to bring in a second drill so we can test both shallow targets and deep targets and keep that information flow coming.
Right. So, okay, let's be clear, because there's a lot. Well, most of your nickel is shallow, right? So that's presumably open pit territory. You're talking about drilling much deeper. You're going to be talking about going underground, chasing, well, presumably high grade. So what does that need to look like for you, again, based on your past experience, in terms of what do the grades need to continue to look like for that to be economic?
So, I'm not going to speculate on being economic, but right now we have a large 16.8 million ton indicated open pit resource that we've published. We also have 14.5 million tons below that pit in an underground resource at approximately 2.07% nickel equivalent. So very polymetallic, copper, nickel, cobalt, platinum, palladium, gold. But if you look at that in comparison to a lot of the mines that are operating in Sudbury, that's sort of the range that they're running in grade-wise, plus or minus. So it's not inconceivable, and I think it's quite logical to make an assumption that a large portion of that 14.5 million tons of resource could be mineable economically. So this is what the PEA is really looking at. So again, if you look at, I'm just going to throw a number out there. This is just a number, but let's say it was 10 million tons of the 14.5 million tons was actually mineable. You could put into a mine plan, put stope design around it, and at sort of resource grades plus or minus. You could mine 1 million tons a year from underground for 10 years. So it's a considerable large resource. What we're really looking to do is make expand on those resources, and we do have a strong optimism that we can expand on them at depth, because that was not the focus of Lonmin Canada prior to us acquiring it. They were looking for low sulfide PGMs, not these typical contact nickel style mineralization. So there are areas that were just not extended to depth, especially in our west deposit. But also in the footwall, where we can see potentially, if we make a discovery that looks anything like what we see in the 109, in the 101, or similar to other footwall deposits that members of our team discovered while with FNX, it could be even higher margin potentially, because Sudbury does have rich footwall environments. So that's what we're looking for with our exploration. So extending on the existing resources that could extend beyond the 14.5 million tons that we currently have, as well as looking for these new, potentially very rich footwall deposits.
Right. Okay. So in terms understand about the going deeper, looking at the underground opportunity ahead of you, but in terms of what the money is going to be allocated for, it's a big resource already. Is this a case of Canadian style, let's just kind of build the biggest resource possible? Or in which case someone will come along and it's very attractive, someone will come along and take us out. That's the usual management line in terms of strategy. Or are you serious about the tolling component? Are you serious about being in the district, being a producer in the district? In which case, what are the other things that need to be on the table, or at least the option of having on the table, in terms of whether it be building ounces through acquisition of your own milling, capabilities, etc. Because it's you've been successful since December, right? So it's very early days, very early days. But you can't help but sort of, look at these things and get excited about these things. But where does that sit in your current management strategy?
So when it comes to, how serious are we about toll milling? We're very serious. This is something we've done before successfully, and I see it as a great option for us. And so we are looking at it in the PEA. We are having discussions with the owners of the mills here in Sudbury, and we'll be able to give more guidance on that, in the next quarter or two. But it is something we see as a path forward that would allow us to become potentially, cash flow positive, not need to go back to the market to raise additional money to advance both Shakespeare, potentially fund other accretive acquisitions in the basin, potentially expand production from an initial toll milling at Crean Hill. So we see a lot of benefits in controlling our own destiny and moving forward. We also see it as low risk. Because we've done it before, we really understand it. We understand the ins and outs of what's required. And we would not want to, let's say, for example, take on a bunch of debt before we were cash flow positive. So we see this as a good option going forward because it's close to surface potentially. And we'll see once we get the PE out, potentially, we may have enough cash to actually get to the point where we have revenues coming in. So these are the things we're going to sort through. We don't have 100% allocated use of proceeds right now. We have optionality. We have 2 years to spend the flow through. We're going to be topped up, with the additional hard dollars that we're raising. So we're going to have a lot of flexibility. And again, looking at, where best to allocate that cash over the next 2 years.
Right. Okay. Which is great. And I hope that someday in the future, we'll talk about that. But again, just sticking with the toll milling, is it a buyer's market at the moment? Is there a lot of capacity in the Sudbury region? And quite frankly, trucking distance obviously changes the economics somewhat as well. So have you started conversations? When do you think you'll need to start conversations? And, more importantly, the capacity component, does that put you on the front foot, or will you just, will the mills actually control that conversation?
So we have been having conversations with the owners of the mills, for months and months, pretty open dialogue. There is definitely interest in working with Magna. Both of the majors who have mills here in the basin seem to have interest in discussions. Let's put it that way. So we'll see where that all goes. The one thing we do have that in the past when I worked for FNX that we didn't have is the option of saying, we don't have to take these terms. We will take it somewhere else, or we will build our own mill and continue to grow the resource while we're doing that. So we do have a bit of leverage and flexibility on how we move forward. That being said, I would say that the two majors in Sudbury, I would consider them partners to some degree. There is I think a desire to work together. There's opportunities. There's things that don't make sense to the majors that make a lot of sense to us. And I think that they see opportunity for both companies to benefit. So I'm very positive on it. I think it's definitely an opportunity, not a challenge, having the two majors in the camp with operating mills that have excess capacity that could toll mill our material.
Yeah, it's an interesting one because those negotiations, both parties have got to feel they're getting what they want out of it. But from your perspective, it's really important for theirs. Is it important at the moment, given the market conditions? Are they able to fill their mills? Are they, how much operating capacity have they got for people like yourselves?
And I can't really speak for them, and some of the discussions are confidential. But what I can tell you is there is capacity. They are not at full capacity. They definitely, and this is a blanket statement, but for the past decade or more, probably the last 12 years, Sudbury has been very much undercapitalized. There was a period there where nickel was out of favor, prices were very low, and there was very little investment into capital to extend resources, new developments and open up new deposits. So there's definitely a catch up by the majors, I would say, right now. And, with the strong outlook for, battery metals, there is capital being invested, but that you can't turn that on overnight. Some of the projects that the majors are working on now have 4 and 5 year build times. So they'll be coming on, down the road. So there definitely is, like I said, interest to work with someone like us who can be quite nimble, make decisions quickly, have resources that are shallow and can be, easily brought into production from a permitting perspective. Brownfield site, small footprint, those types of advantages, and we're continuing to have those conversations. And again, we hope to give more guidance in the coming months. But it is very positive, and it is a goal this year for us to be able to have permits to at least get a bulk sample to have a better understanding and potentially ship some rock that we can get paid for.
Right. And so what's the capacity, what's the limit on the bulk sample? In terms of not in terms of how many samples can you do, and what's the total tonnage before
and
they
these
go?
are discussions having with the ministry. Typically in Ontario, a 50,000 ton bulk sample is pretty standard. There's cases one off, and then and there's cases where it's gone up to 100,000 tons. So that would be sort of the size of an initial bulk sample. But what that does is it really demonstrates a whole bunch of things, including being a good steward of the environment, and allows a better understanding to give support for commercial operating permits.
So what would that, again, give us some clues? Obviously not talking about yourself, but just generally in the market, Sudbury, you said there's, lots of players in there. If it was that 50,000 ton at say 2% nickel, I don't know what the toll mill agreements look like. Is it 50-50 on the net number, or how does these things typically get negotiated?
They're negotiation, is what I can tell you. Again, it's very confidential. These everyone wants to sort of keep their cards close to their chest, so to speak. So, what I can say is that in the past, FNX, typically would mine 1.2 to 1.4% nickel. The copper mineralisation they mined was anywhere between 2 and, as high as 10% copper in some deposits. But, FNX made a lot of money at sort of, varying parts of the metal cycle. So we believe that, with the grades we have, the economics are similar. We think it can be profitable, but again, we're doing our PEA and we're getting a better understanding. And at this time, we don't have terms, so we can't say anything for sure, but we're pretty optimistic.
I'm trying to work out what sort of financial contribution the 50,000 ton could bring to the company, and then in turn what one could do with that. In terms of ballparks, you'd hope for somewhere between this and this, and what would they look like?
Well, so the benefit of doing a bulk sample, and there's multiple benefits, but one of them is you can drill off a deposit, and especially these footwall deposits, which are breccia hosted. You have class of unmineralized country rock with sulfide mineralization wrapping around in the matrix. And what we've drilled in the 109 footwall, which is that low sulfide with that high massive sulfide core, as well as the 101, that they're both in those environments. So until you actually get in and you start following these systems, this matrix of massive sulfides, it's really challenging to accurately model unless you're drilling it off at 10-meter spacings. So there's a real benefit in getting in, chasing some of these, and I'll call them sharp-walled veins, because essentially that's what they are, wrapping around these blocks and understanding better so you can increase confidence in your mine design going forward. Now, that being said, if you're chasing and doing selective mining on some of these sharp-walled veins, and we did this at FNX, there's not a lot of dilution. Now, you can go and bulk mine it and take a lot of dilution around these class. So there's different ways to mine, different mining methods that are effective. But at FNX, we did a lot of selective mining, because if you're paying a toll milling cost and you have to pay to truck that ore to the toll mill, the more metal in every truck, the more advantageous it is. So, if we use selective mining, there's potential, definitely some of the bulk sample could be much higher than 2% nickel equivalent. So there is if you start talking at 22 pounds of nickel per ton and you have 2%, there's 44 pounds, and you start looking at what's nickel today, $12 US, 1650 Canadian, times that times 44. It starts to add up. Now, if we were mining material that's substantially higher than that, which there is potential for some of it to be higher than that, maybe you could double that. So it starts to become very valuable rock. But what it really does, it gives us the understanding to build a better plan. And once you start mining, it's much easier to have supportive stakeholders. You're hiring people, good things are happening. You have some cash coming in. So it is a nice way to transition from a bulk sample into steady state toll milling production. Now, again, very forward looking, may or may not happen, but we've done it before. Our team's done it before. I've personally done it here in Sudbury before. We understand the process. We understand all the players. We have great relationships with the service providers here, such as the mining contractors. So there is we see a very obvious path forward. But again, we'll be able to give more guidance on that in the next, call it 3 to 4 months.
Okay, well let's come back to that another time. So that's brilliant. Thank you for that answer. So just confirm for me the delivery of the PEA you're aiming for when?
Early in Q2.
Early Q2. Just say Q2. You don't roll for your own back there. Right. Okay. In which case, let's go to the money. Back to the money, if we may. So you obviously got this 60 million of flow through. In who was it? Mostly retail, or did you started getting the interest of some of these institutional guys? What's the mix?
Yeah. So we had we have a great institutional shareholder list, and we've had some very big funds. Some of the biggest that invest in mining companies and reach out to us. And basically, most of the financing was done with the 2 institutions, the bulk of it. And then, some existing investors came in, and as well as, a small number of retail investors who are already in the story that follow us closely. So it was a very small group. We were able to get the book closed very quickly. Essentially, as soon as it opened, it basically was 90% full. So it was great. It was I have to say it was a lot easier than our $20 million financing in the summer.
Yeah, well, nothing was easy back then. So just again, give some clues. Are you saying these are 2 new institutional buyers, or do they come from the some of the top shareholders you've already got in the shape of Dundee, Hawkes, or Hayward?
Yeah, 2 new. No. I can't say 100% that they hadn't bought some in the market, but they're new to participating in the placements.
Okay, and that puts them at what percentage roughly?
I'd have to get back to you, but under 10 for sure.
Okay. That is fair enough. Okay. Just on that, in terms of the structure of these things, people always get concerned over the way that these deals get structured and the games that are played. In terms of people invest in these placements because they want the warrants and they dump the stock in the market. You like a lot of these types of deals have got a 4-month hold. I'm going to ask you the obvious question because it happens every single time a company does this. Is what happens when that hold comes off? Should people be concerned? Is that a kind of sticking? So is it a moment where you think perhaps you could get impacted negatively?
Well, I think that from our perspective, it's not something we're worried about because it's not like our stocks performed very poorly. We did the 27-cent financing at a peak, and now everybody wants to get out, and run for the hills. We have very, very happy investors. The stock's up. Well, we did 27 cents, and we're somewhere north of $1 today. So investors are very happy. Now, that being said, in the 27-cent financing, there was really 2 big shareholders who are insiders that participated in that, plus management and board and other insiders took up another good chunk of that. So all in all, let's say of that $20 million financing that we did that's coming off the end of this month and become free trading, at least 65 to 70% of it is people that are long-term investors. They're not selling. If they did sell, they'd have to report it, put it that way. So of the other percentage, again, many of them are very happy. Some of them may have to sell some to just rebalance their portfolios because it's gone up now and maybe it's too large of a weighting. So they may want to trim a little bit or may have to trim a little bit. But at the same time, because there was lots of appetite for our financing, many institutions did not get anything or did not get their fill because we essentially just had 2 big institutions come in and take it up. So we do expect that and we've been trading lots of shares, there's still lots of appetite in the market for institutional investors that can buy up big chunks if some come available. So we're really not too worried about it. And again, it's not like there's anyone short in the stock because they think there's going to be a financing. The financing's done. We're not raising no more money. So I think that, it's not something we're really worried about, but obviously it's a question we get asked quite regularly. And we think that now with this financing done and the fact that large investors came in and participated in this financing at $1.10 on the hard dollar end, shows that they're not overly concerned as well.
Right. Okay. So, and I guess final question is really in terms of the makeup of the resource, and perhaps we could get you come back onto a slightly more technical, interview with regards to the drill results that you've seen so far. But for today, just keep it kind of fairly high level in terms of the makeup of the commodities that you're looking at. Obviously, we're talking nickel, but it's a nickel equivalents, and you've talked about copper and PGMs and gold and all sorts. Are you seeing much variance in terms of the contribution from the kind of the derivatives that you're seeing?
Matt, that's a great question, and I think we touched on in one of our previous interviews. Are you a nickel company? Are you a PGM company? What are you focused on? And the great thing about Sudbury is that it really is a polymetallic camp. So different zones within the same mine footprint can have, very different economics based on the metals that are in them. So, for example, the first two holes we released were in the 101 footwall zone that were, 95% of the economics, 90% of the economics were from nickel, and with a very small amount of copper, PGMs, and cobalt. Whereas the 109 footwall zone was very much the economics were driven by precious metals, with a byproduct of base metals. So, and then you have your typical contact style mineralization, which is probably 95% of the mining that's been done in Sudbury over the last 100 years. And it's a 1-to-1 nickel to copper, which is a little bit of cobalt and precious metals. So we have all three of those styles of mineralization right now. The mix of how we're going to mine them will be largely driven by, proper mine sequencing, but it'll also be driven by if copper is much higher, we may want to produce more copper. So we'll be looking more at these contact zones where it's 1-to-1 nickel to copper. If nickel's higher and say precious metals come off, we may decide not to mine very much of the 109 footwall zone. The nice thing about toll milling, if that's the route that we're going to go in the near term, is that you can be flexible. And we did this at FNX. In 2000 and at the end of 2008, after the financial crisis, and we had to restructure our operations, we actually shut down a bunch of our nickel mining and focused on the copper-rich, precious metal-rich footwall environments. And that's where all of our mining came from, because that's where the economics made sense. And we were able to do that pivot and be quite profitable from it. So that's the great thing we have. So right now, I can't tell you, but we do have a lot of flexibility. And each one of those deposits, I think, could be a standalone deposit. In some of the holes, and this is just something I've noticed in looking at some of the best intersections that have come out over the past month. Often, you look at the top 20 copper intercepts. One of our copper intercepts, even from our low sulfide footwall zone, and copper as a byproduct, made it in the top 20 best intercepts. And so it is kind of, we do have great, grades in all our deposits for multiple metals. It'll be an interesting mix.
It'll be an interesting mix and lots of options on the table. But and maybe you can come back on. We'll get a little bit more technical next time. I think people will be fascinated given that optionality and what's happening in the market with commodity prices. But hopes for this year beyond the PEA, what happens next?
So big program, lots of exploration going to be happening, like I say, both at Crean Hill and at Shakespeare. Our base case, which we had already, give guidance on back in December, we will have 2 drills turning, one out at Shakespeare by Q2 and then one at Crean Hill. More than likely, we're going to ramp up the Crean Hill drilling because of, the extra funding we're going to have. We'll be looking for footwall targets. So, I think obviously, exploration's high risk, but I think we have a better than industry average chance of finding something in the footwall just based on the experience and the information we have. And we have two footwall mineralized rich corridors to explore further out from the main deposit. The other thing is we will be working very hard on putting together a early mining plan. And again, we hope to give guidance on that in the next 3 to 5 months. And potentially that could be, starting some kind of bulk sample advanced exploration, within the next 12 months. That's our target. There's always a chance it gets delayed, but that's what we're really working hard on this year.
Brilliant. Jason, thanks for talking to us today. See you soon.
Thanks a lot, Matt. Take care.